All right, stock started the day on a pretty negative note. In fact, you had clusters across the board on the Dow, on the S&P, on the NASDAQ. Of course, we know the Russell's been cluster mode for a while. Pretty bearish patterns everywhere. After an opening gap, filling in the gap, getting down to the lows of the day. But then a big change. We rallied pretty sharply around midday and for the most part held a lot of those gains. And it was interesting that you had a pretty predictable reasoning for the bearishness throughout most of the day. And then we'll talk about what that is. But it's the same as we've seen before, and I'll show you. But what's interesting is how bullish we were at the end of the day, and those other factors didn't really change that much. So it kind of goes to show how much pent up buy the dip is out there, and it really came in at the lows of the day today and kind of overwhelmed the selling pressure from these different intermarket relationships. I'm going to break that down. We're going to take a look at, okay, what does that mean? Like, does that mean now, okay, this intermediate decline is done? Are we not going to have a correction? Or are we going to have a correction? So we're going to have that discussion still. We kind of talked about that in the last video. We'll continue that now in today's video, and we'll take a look at the sector moves. And there's some significant sector moves going on here. But we're also heading into like the end of the quarter, which means earnings season's coming up before expiration. So there's a stock that's setting up for a trade before it kicks off the earnings season here before October expiration. We'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, September 27th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video I do at 3:30 Eastern time before the market closes. We get the trade idea on that you'll hear at the end of the video today. We've already put it on before the market close. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Same thing here. Click the thumbs up icon. It opens up this tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. So it's a big deal to us. That's why we always ask. We try to get to 100 likes on the tweet. I'm getting close. I'm still in the kind of the 80s, but at least I'm in the mid 80s now. So thank you to those who like these posts on these day in and day out. We really appreciate that. Those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we were up today by less than a point. A nice rally off the lows of the day today. But when we were at the lows of the day, we were in cluster mode with the intermediate line below the 5th percentile, which is so rare for it to get that low. But fortunately, the rally actually brought the momentum line out of the reversal zone, kept the near-term line from getting into the reversal zone. And then, of course, your intermediate line stayed still pretty oversold, but at least it stayed above the 5th percentile. It just goes to show just how bearish we've been here. We are now closer to the moving average, 3 1/3%, though it's still a pretty decent amount. Obviously, dark pink shading in the red line, that's not changing anytime soon. So we still have a bearish posture, and we'll see if a long lower shadow turns into something that's a little bit more bullish. That's kind of what I think we'd all be hoping for here. If you take a look at the NASDAQ 100, it also had a cluster earlier today. Again, the rally off of the lows pushed that momentum line up, kept the near-term line from falling, and then your intermediate line still oversold, but not below the 10th percentile. You can see market sentiment is dropping. It's almost below the midpoint there. It's actually closer to the midpoint than the S&P is. The Dow Jones Industrial Average, it's actually the first. It's barely just out of the bullish territory, so it's actually the most bullish on the long-term line. Also avoided a cluster. We had a cluster for most of the day today until that last little rally, and then your Russell 2000 never did have a cluster today because it was always the most bullish. The momentum line ramped up The near-term line ramped up as well. Its market sentiment's actually close to falling into bearish levels. It's the furthest below. It has been the most below the moving average this entire time. It has been the most bearish of all the indexes, and today kind of holding its lows better than some of the other major indexes are. So pretty, again, still a bullish posture, and you're not. I mean, and maybe I'll just bring this chart up just to remind everybody. When you're in intermediate bearish trend, not every day is a down day. And I know it seems that way. Like, again, here's the last time we had an intermediate decline. You can see all the big down days we had there, 1% or lower. It's pretty obvious to tell where the intermediate declines are. Let me zoom out so you can see even more context here. Let's go out to 3 years so you can see the bullish trend of 2021. So you can see where the intermediate declines are and where they're not. So even like, for example, here during an intermediate decline, there's going to be up days. So just the fact that we had an up day today, and granted it was about as small an up day as you can get, smaller actually than what we saw right after the intermediate decline started, right, with that 1% decline over there. At least this last leg of it started. So it's not that big of an update. We did gap up pretty significantly, relatively significantly, and then obviously filled in that gap as we approached the lows of the day before coming off of those lows and then finishing just above break even. So just a reminder that excuse me. Just a reminder that during intermediate declines, when you do have dark pink shading and a red line, that doesn't mean that every day is going to be a down day. You're going to have up days. We've had two this week. We've had two, Monday and then now today, and now we'll see how we finish the week. Hopefully, we finish it on a little bit of an upswing. That would be ideal scenario, I think, for everybody. I don't expect that we will, but I think that would be the ideal scenario if we did. So that's how the market forecast is looking. Let's take a look at how that weekly chart, which had really, look how deep that's a pretty decently sized bearish candle. We haven't had, this size of a candle that was bigger than these two. You have to again be back in intermediate. You have to be back into a correction mode to get this size of a candle. We still have 2 more days. Now that the Hakinyashi close can go lower if we finish lower the next 2 days. It can also go higher if we finish up higher, right? It's an average. The Hakinyashi close is an average of the actual open, high, low, and close values on the SPX itself. So it is really close to that 40-week moving average. Remember, the Russell 2000 has already crossed significantly below that line, and that's getting below that 40-week moving average typically starts corrections. And there we are, right? And you can see clearly, and we're in a death cross environment now as the 10-week is crossing below the 40-week. So we're close to getting that on the S&P. Remember, the Dow is a little bit more bearish than the S&P, not as bearish as the Russell. So we are actually getting the Hakinyashi close below that line, and we're still about 1% away from it. Getting us a death cross, but again, getting below that line. See, when you're bullish, you stay above that line. So getting below it is, that's a big deal. Last time we got below it was the banking crisis, and we had, a liquidity intervention to be able to avoid something worse than what we got. Again, like we talked about in our last video, most likely not going to get that kind of intervention this go around. Let's take a look at the 3 green arrow charts. Now that we were a little bit bullish today, right? We weren't as bearish. And you can see 3 red arrows still across the board. So pink shading on all 4 charts. The MACD histogram is gray on 3 of them, which means the histogram is moving back towards 0. Usually the MACD is the first one to get that green arrow. The moving average is usually the last one to get the 3 green arrows. So the MACD, at least it's the bearish momentum has had a little bit of a pause, but we are clearly in a bearish intermediate. The Russell has been this whole time. The Dow has been for most of this time as well. Remember, they had 3 green arrows that both failed. These didn't really have 3 green arrows that failed. They actually worked out pretty well for a little bit of time. Didn't quite have the green line. The Nasdaq kind of had a green line for a little bit longer than the S&P only had it for a day. Of course, we never did get the green line on these two over here on the right. Looking at the two-line version of this chart for the S&P, again, filling in the gap between the 50 200-day moving averages. That's what pullbacks do. As of right now, you would still constitute this as a pullback. So if it ended, we would expect to get back up to new highs pretty quickly. I don't think it is. I think it actually will be a correction, which means more of a move below the 200-day. But I do think that at least for this particular run, we're more than likely going to get a move towards that 200-day before a pause, right, and a little bit of a move back up. So I think we'll still probably maybe by the end of this week, more likely probably by next week, as I think we'll get a little bit of a near-term rally right now towards the 8-day. I mean, look how far below the 8-day moving average we are. It is not common to stay this deep below the 8-day moving average, and especially for that matter, not common to be this deep below the 17 days. So you can see here, how far below the 17-day moving average we are. And this is pretty low levels. That's about as low as both of these last pullbacks got. And then again, looking at some context here for when the correction started. If you follow my cursor all the way over there to the beginning of 2022, we got a little bit lower. So that kind of gives you an idea of how normal pullbacks behave versus pullbacks that end up turning into corrections. As you can see, we actually did get below the 200-day briefly before the failed pullback bounce, and then we really got going on that correction there. Especially over here when you failed in March, back when Kramer said that this bear market was over. First of all, he called a pullback a bear market, which is kind of goes to show how how much he actually looks at charts. And then second of all, that was when Tom Lee had his price target for 2022 like in the 5,000s on the S&P. So needless to say, that was not a very good time for market forecasters as we continued into the below the 200-day moving average started to fall then. So that's kind of what we're seeing right now. If you look at the whole moving average, again, like the 200-day whole has turned lower. So we're red now, and we have been in the last two intermediate pullbacks. We did get there. We are a lot. Look at my cursor here, all the way to the left. We are a lot further below the 200-day whole than we ever were in any of those pullbacks. So again, for some context here on how deep we are below the 200-day whole, you follow my cursor all the way. Let's go 3 years. Excuse me. Go back 3 years so you can see this bullish market. So now, again, look at my cursor, follow it all the way to the left, and you can see during normal intermediate declines, we don't get this far below the 200-day whole. It might turn red, but it doesn't. We're not gonna. It's not gonna be green for a long time, barring a dramatic reversal here. So I mean, that's pretty clear. You can see the size of the candles, how big they got. Again, relative to typical decline pullbacks, your normal pullbacks. So we are clearly in bearish mode here. You can see on this weekly chart too. This how we are red on the 20-day haul. We're getting closer to that 200-week haul. Excuse me. And when you cross below that, it's pretty bearish. As you can see, that's typically correction when you do that on all these other instances. So we haven't done that yet. But you have on the Russell, right? The Russell has crossed below its 200-day haul, as you can see the PPO down here. So now, of course, do we follow through with that, or is this going to be like a little one touch? That generally doesn't happen very often. So more than likely, it will be the other way. We will continue lower, and all these other times when you've broken below the 200-week haul, the haul was moving higher. It was green. Even COVID, it had turned briefly green. We didn't turn green here. Not on the S&P we did, but not on the Russell. Because it begins to show, the Russell 2000, I believe, is actually already in a bear market. And this is one of the indications, another indication, that it is in an actual bear market mode here already. Which I believe is another reason why I think this pullback will turn into a correction that will actually turn into a bear market eventually as well. I mean, of course, that doesn't start for months or weeks from now, so we have plenty of time to watch for that. But because of what the Russell's doing, I expect that the S&P will most likely do the same thing. Looking at some of these other oscillators, we're still in breakout mode. Today didn't change that. There, you have to get this red line, purple line, excuse me, across below the ADX. So that hasn't happened, not even close. The RSI and the CCI, we have to get up to a positive 100 on the CCI to kind of change what is a new bearish mode. As you can see, the weekly CCI is way down there. So we have to at least get above positive 100 to try to change that and get the RSI at least above 50, if not eventually above 60. Obviously, that did not happen today. So again, goes to show that we're not, one day obviously does not change the direction. Looking at the Ichimoku cloud, you can see we are in full-on intermediate trend strength decline below the cloud as we're approaching the pink area. Again, another indication of correction, not just pullback. Same thing here. We're way below by the time we get to the pink. Again, another indication that we're in correction, not just pullback for the Russell 2000. Remember, the Russell 2000 is actually way below its 200-day moving average. So you could argue that, it's, while everything else is still kind of flirting with the potential of pullback versus correction, the Russell 2000 is clearly in correct. I mean, we came to the 200-day already, failed, and then, that's a pullback. That's a failed pullback bounce. And then here's your correction. So you could argue the Russell, as it did at the beginning of 2022, has already kind of leading us into the different stages of bearishness here. Finally, looking at the Keltner channel, again, as bearish as we've been and as bullish as we were today, we are still in the lowest quartile, easily in the lowest quartile of the bandwidth, and we are still below the Keltner channel. I mean, long lower shadows, so be aware of that. Those are pretty bullish. So let's see how we follow through on this one-day candlestick pattern. You need to follow through on that to confirm it. The momentum is pretty bearish. It's not as bearish as it was. Let me show you some context again. So when that bearish momentum is in correction mode, follow my cursor to the left. You can see in the corrections, it gets a lot deeper than this, right? In pullbacks, this is about as deep as it gets. But again, if we're expecting correction, and I expect that we are, then we still got some bearish momentum. And again, clearly, we're still way below the Keltner channel. It's not even close, as bullish as we were at the end of the day today. So we need to at least get above this Keltner channel, get out of this lowest quartile of the bandwidth for us to feel like, okay, at least we're not bearish anymore, and we have the hope that this will just end up being a small pullback and a move back higher. So that's kind of what's going on there from a technical perspective. Let's take a look at the intraday move today. This was a really good sign, actually. Not only did we get the long lower shadow, but we closed above yesterday's low point. That's a very, very good sign. So we got above yesterday's low, and it was a lower high, lower low, but closing above the low, it's a small positive, but it is a positive. So that's a good sign. We did get a new low. So again, we're not looking for any change in direction back to the bullish side until we get the red line below 70, green line to 0. We're still a couple of days from the green line getting to 0, and the red line is going to take 6 days to go from 100 to below 70. So we're still at least a week away if we're actually going to turn this ship around, not just these one that kind of gives you an idea, like, don't get so worked up about 1 or 2 day moves to the upside, because as you can see, it takes 6 days. So if we end up getting a 2 days or 1 day rally, and then we get a new low point in the next day or two, and we're right back to 100, that resets the clock. You got to get the red line below 70. You got to get the red line below 70. You got to get the red line below 70 before you get the breakout to the upside. Got to get the red line below 70 before you get the breakout to the upside, and a new intermediate trend starts. Today's volume and range both ended up being pretty strong, above average on the range. You can see 5 points, 100 million on the volume. You can see that's having an impact on the averages. They're rising. They're not rising very fast, and we're not even to 150% yet, which is what intermediate declines typically get to. So that's why, again, I don't think we're close to being done, because we're not anywhere near that. And then again, that's just for pullbacks, much less corrections. Again, you may zoom out here so you can kind of see some context. Again, the last couple of pullbacks, You can see we're 150%. The corrections got well above 150 towards the 200% level. Here's the other pullbacks got to 150 back in normal levels. These pullbacks got a little bit higher than 150 because they came off of higher lows. This pullback over here almost got to 150, got to 130 before that came off of a much lower low. In fact, we got a kind of a higher low come with these lower highs. So you would expect, this isn't too low, you would expect that we're going to get most likely up towards 150 by the time all is said and done. So we're not anywhere near the ending stage. And here's another sign. If you look at the VIX, the VIX did close above the 200-day moving average today. It did get almost up to 20. It got up to 1960 today. So, but it's still only at 95%. For some context on this, again, typically pullbacks will get you where the VIX gets up to at least 100, if not 105% during these pullbacks, right? But generally, for corrections, and that's the crazy thing about this correction we had in 2022, for corrections, if I were to go back to, let's go to a weekly chart. If I were to go back to like 2018, this correction, you can see we got well above. We got up to about 115%. COVID obviously got well above 115%. 15 and 16, we got up to 115%. 2011, we got to 115%. So it doesn't just get to 105%, which is like what all these other little pullbacks do. It typically gets to 115% for a correction. So we're just at 95% right now, and we're barely, in fact, it might have actually come back down below the 200-day moving average. Let me see here. Because the VIX really dropped today. It was down almost 4% off of the highs. So we didn't quite get, but we got close to the 200-day moving average. You can see, look at the momentum there. This is the highest momentum on the VIX move as the banking crisis. So, and the stochastic is actually higher than it got during the banking crisis. So this is a very significant move. Again, very similar to 2020 during that correction. Very similar to what we saw in 2018. Very similar to the type of move we saw in early 2022, where essentially, and especially late 2021, where essentially we went from a low volatility environment to a new regime. You can see it was in late 2021 that we basically got above the 200-day moving average and then stayed there. I mean, obviously it came down a little bit a few times, but pretty much stayed there. So we changed the regime and got above the 200-day and stayed. That's what you do during corrections. Pullbacks, you get above it, you come right back below it. Get above it, come right back below it. The 200-day continues to move lower. But corrections, you get above it and it stays there, right? That's a new regime. And this type of momentum that we've been getting on the VIX has been the type of changes from being a bearish volatility regime to a new bullish volatility. Now, we're not very far above the 200 days. So if you change this MACD down here to how far above that 200-day moving average we are, right here, there we go. So as bullish as this momentum is, we're still barely we're barely above the 200-day. You can see on all these other corrections, we got a lot further than just 3%, which is where we're at right now. We were, over here in 2011, we were 55% above, and in COVID, you can see, and even at the beginning stages of 2018, we were in, high levels. So this is not high levels yet. This is more in line with, other typical pullbacks that we've seen in the past. So again, you can kind of see that even volatility is telling us that we're just kind of getting started here. If you take a look at the breadth, let's take a quick little look at the breadth, and then we'll move on to the different asset classes. We still have very bad breadth, and we're really marching our way towards minus 500. Again, we don't typically get below minus 500 during regular pullbacks, right? You get below minus 500 during the correction stages. And again, barring a significant change in sentiment and a significant change in the breadth, we're going to get below minus 500. And we've already gotten below some of these other levels here. Here, let me go to the new highs and new lows. We've already gotten below significant levels here that are, again, more in line with deeper declines than just pullbacks. You can see the average for the new highs and new lows already below minus 250, working their way towards lower levels. It wasn't so bad today, but look at even the number of stocks above the 50-day moving average. As nice as the day it was coming off of that low, we didn't really improve here very much. We're still easily below 100. The average is about to drop below the key 150 level, which it did briefly here with the banking crisis. But again, remember that that was looking like correction until the Fed stepped in and really increased their balance sheet pretty dramatically. To try to stave off a banking crisis. So otherwise, we have a much more serious issue there earlier in the year, but we avoided it and really got bullish with the AI craze over those two earnings cycles. And then now you can see we're back in that level, and that line's about to cross again. That line does not cross below the moving average, the 20-day average does not cross below unless you are in correction mode. As you can see all these other examples over here, and so we're just about there already. And like I said, even the number of stocks above the 200-day moving average is at low levels too, and the average is also about to cross below the 50% mark, which again is more in line with the type of breadth you get during more significant declines. All right, now let's take a look at what's driving the price action here. So let me pull down just today alone. Oh, you can see that here. So here's today alone. So small caps really, which is again is interesting. We had the three-headed monster today. We had bullish commodities, and they didn't close right at their highs. They were a little off their highs, but not much. The dollar again closed not at the highs, but a little off the highs here at the end of the session. You can see. And just them coming off this much off of their highs, look at how much stocks rallied. So a little bit off their highs, but not much, not this much, right? Where you can see the stocks went from being down 0.2%. Even the S&P and the Qs. IWM at that time was actually pretty bullish. And then you can see yields at that same time. That's how much the bonds came off their lows. So yields came off their highs. So little bit of a, coming off, but that's your yields were up, bonds were up, commodities were up, and the dollar was up. That's your three-headed monster for bearishness lately. The last couple of years, 18 months or so. Gold really, really down today. So that continues to be the theme. I mean, look, yields took a big leg higher up to above 4.6%. I mean, that's one of your bigger moves higher that we've seen in yields when you look at the daily changes here. It's one of the bigger moves that we've seen here in a while. Another up 1%. And this is kind of keep in mind. Let's look at TLT here as a reflection. Not clearly is down, not these up as 2% like these other 2 days, and again off of their lows, but you can see this wasn't an up day, and yet stocks were able to maintain some level of bullishness there. So bonds, the dollar, that also had continued its run up to the upside. You can see moving up above 106, clearly moving higher towards 108 and beyond. Well above the 200-day golden cross environment here. So clear strength of trend when you look at the trend strength indicators here. You can see a very mature trend strength that we haven't had on the dollar. I mean, you have to go back to back over here where you had a good trend strength for quite a while. Got a lot more bullish than this. And look at TLT, and you can see we're not quite a mature bearish trend, and we haven't had any kind of bullish trend whatsoever. This was the only time we had a little bit of a bullish trend on bonds at the very end of 2022. It's been bearish and the rest of the time, and you can see as bearish as these moves were, we're not as bearish now as we were even this last leg lower, but still a pretty bearish trend to the downside. And of course, crude oil has been the big mover to the upside, up above $94, up above the 50% retracement now of this correction that it had in 2022 going into the beginning of 2023. Obviously having its impact on inflation expectations. clear rate of change, way above, 26-day rate of change, very, very high, very mature trend strength. Again, we've had a couple legs now, a very mature trend strength that we haven't seen since back over here. So we're in that mode. Commodities is in that mode. And I think especially if you look at it on a weekly basis, you can see it's just kind of getting started, and we're just almost above the clouds. So this 95 is an important level in a variety of reasons, not including the Fibonacci, but this cloud. And you can see, where we had a pretty significant bearish trend going for this weekly move, we're starting a new intermediate trend strength for a bullish trend, and we'll see how long that ends up lasting. And again, its impact on inflation expectations. That's the big kicker, right? That's the issue and the problem. So, that's why stocks have been, bearish, and that's why they probably won't turn bullish anytime soon unless there's a significant change in the trends of these major assets and the direction that they're headed right now. Let's take a look at the sectors. That's what I wanted to look at. So just pull down here to the comparison and take a look at today. Look at energy. I mean, that's the thing too. And I'm going to show you a ratio chart here in just a second. But look at utilities. Look at over the past 3 months, utilities and real estate, very interest rate sensitive areas, getting absolutely hammered. Energy up 17% in an environment where stocks are bearish as a whole, and then staples too getting hammered. And this has to do more with kind of those dividend stocks that are somewhat sensitive to interest rate changes, not as much as these other two sectors, but somewhat to a degree because of their dividend payments. And look at today's move. Big drop in utilities, big gain in energy. So I want to bring up that ratio chart of energy relative to utilities. It's a pretty important chart on a ratio basis. It's normally pretty positively correlated to the markets. Has not been and lately with this inflationary environment. It's been, the ratio has been bullish because of the bullish move in commodities and crude oil. But the markets have been, were bullish there, so we were still bullish there. But then in 2022, the markets were bearish. That's why this correlation dropped down to zero. But you can see, like, it's really gone. I mean, look at this move today. It's way up above, like the 30-day moving average, way up above the 50. Like, that's not a ratio. Like, eventually this correlation, which is deeply negative right now, and that's not normal, eventually this correlation will turn back to being positive too. And again, which direction will the ratio go and which direction will the market go when they both go in the same direction? Considering how, really parabolic it's going right now. Look at that CCI, how bullish it is. You can see the big move in there. The RSI is above 70. It's a very, very big move for this index. Way up above. If I were to change this PPO down here to how far above like that 30-day moving average we are right now, so kind of an intermediate momentum measure. I mean, that's how far up above we are. It's a significant move higher. Usually not one that would last, without some kind of short-term decline. So look for energy to start to underperform utilities. So either that's going to be a scenario where commodities come down hard and that will be bullish for equities. That's probably not going to be the case. Or commodities stay elevated. Energy stocks do okay relative to like XLK, XLY, XLC, but risk aversion drives more people into utilities. That's the expectation that I have for this ratio to come down. I expect utilities to start to outperform, but not because energy is declining with a big drop in commodities. I don't see that happening necessarily anytime soon. All right, so for our trade idea of the day, let's take a look at JP Morgan here. JP Morgan has been in an intermediate decline too, but unlike a lot of other stocks, has not broken below these lows that we saw over here. So a little bit less bearish, some of these banks, JP Morgan especially. You can see the near-term line did not, it's really come back out. It's not necessarily in bullish territory, but at least it's the near-term line's crossed above the intermediate line, which this is a big deal here because it's the intermediate line still between 20 and 80. So any cross above it, when it's kind of in that mode, is actually a good sign. So that's actually a pretty decent move. You know, obviously dark pink shading and a red line, but not nearly as bearish as even what the broader market is showing. Let's take a look at the weekly chart for this. You can see again, you know, a bearish. We got the red arrow on a couple transition candles. It is a bearish candle, but you can see it's a much smaller bearish candle than what we even saw over here. So even that, again, bearish candle, but not really that bearish. Looking at the 3 green arrow charts, you can see we do have 3 red arrows, but you can stochastics is not in bearish territory. The MACD is forming a higher low right now, and it's barely negative. The price of, you know, we're just barely below the 8 and 17. They're both sitting right on top of the 30. You're at the top of the value area, kind of holding the top of the value area right now for a support on JP Morgan. So it's actually a pretty good pattern. If you look at like these kind of other oscillators, no clear trend. Both indicators on the DMI are below 25. Looking at the RSI and the CCI, neither one of them are below minus 100 or above positive 100, or below 40 or above 60. I mean, both in neutral levels. Looking at the Ichimoku cloud, you're a little bit below the cloud, the small negative rate of change, but you don't have a trend going anymore. You had a bearish trend, it's ended. So you don't, you know, you're trendless right now. And of course, when you look at the Bollinger Bands here, we are out of the lowest quartile. We're in the lower half of the chart, but a very small bandwidth that's falling, and very, very little momentum with red dots, which means the bandwidth is inside the Keltner channels. So we're not really breaking out. There's no trend. Now there is earnings coming up before the next expiration cycle. But I still, even with that, I still think we have a good opportunity to sell an iron condor here, selling the low 20 delta, $2 away on this side. It's $2.50 on this other side. Again, selling the low 20 delta. You know, setting up it's a little unbalanced because of that, but nothing too significant. Setting ourselves up for about 3/4 of our risk to the downside, normal risk to the upside, but pretty good return for a normal risk, nearly $500 there. And you can see where my break evens are. My lower break even is significant support level there. So I really like that. And then the upper break even, of course, we would be breaking through all these moving averages and Fibonacci levels and previous highs. And we'd be back to a pretty good directional move to the upside. We don't want to be in a neutral trade like an iron condor anymore if that's the case. So I like where my break evens are as long as we stay in this area. Then through the earnings, that's pre-expiration, then we should be just fine. Like I said, bigger risk I think is to the downside considering the market environment. And because of that, I have less risk than what I normally get to get this type of return. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us on MarketScholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.